Welcome back to Starting Up. In the second segment of this show today, we look at which are the other sectors apart from e-commerce which investors are really looking at, where the exits coming from these sectors. So we want to start with you again. Internet has been primarily driven by e-commerce this year. You guys have also made some investments in healthcare, IQ recently, also some clean technology bets. What's your take on these other sectors? Where's the exit visibility for these new sectors?
We've taken a strong bet actually on the whole software space in the last couple of years.
Sure.
And I think that what we believe is that we are seeing a reverse brain drain of sorts over the last half a decade of people coming back and working for captives like Sun, Microsoft, Adobe, etc., who are leaving to start companies that are focused on global markets.
Okay, and other sectors, healthcare, banking, finance, healthcare, education, you guys have taken some healthcare bets as well.
You know, we've taken some bets, but we've taken bets very cautiously.
Okay.
If you've sort of followed us over the last couple of years,
Sure.
we've taken bets where we believe that there is a capital efficient model that we can invest in that can generate non-linear return in a venture period.
Okay.
And an early stage. There's a lot of, I think, private equity type bets you could take in healthcare and education, which we've not taken. We're not in that space.
Dhiren, you guys have also invested across multiple sectors this year. What's your take on technology versus non-technology investments? What are the other sectors that are catching your fancy?
So, well, in technology, of course, we're also looking at the rest of the internet, which is non-e-commerce, and those are definitely more non-linear.
Right.
In the non-technology, we're trying to see things which are both kind of online, offline, to give it that non-linearity, but we also like everything to do with consumer.
Sure.
So whether it is consumer finance, it is consumer kind of, healthcare, education. So those are some of the areas which we think will kind of grow pretty well.
Right.
I think there you have to be careful that it has some scale. And typically they might be mid to later stage investments, especially if you're looking at foods, and these are some of the sectors which we're looking at. But at the same time, we think that the same middle class kind of story plays out to these sectors as well.
Great. Pradeep, you guys are more technology focused than others.
Yes, we are strategic investors for Intel, so our focus is the technology space.
Yeah, within technology, any subsectors you're seeing fundamental growth in, or you think it's primarily web driven?
I think most of it is internet driven right now. That's where
Okay.
we see the high growth companies. But this year marked two interesting investments for us.
Right.
One is one of the, I would say, first real silicon deal that we have seen,
Sure.
Sankhya Lab that we funded.
Right.
And the other was in the healthcare space, a robotic surgery center.
Sure.
So very unusual deal from a technology point of view. We haven't seen this in the 12 years that we have been investing here.
Sure.
So we are excited about some of these newer ideas coming out. I wouldn't say these are necessarily high growth areas because we are not seeing a lot of deals.
Right.
But we're starting to see things come up that are making us sit up and take notice.
So Alok, you guys raised a lot of eyebrows by investing in Happiest Minds. Services investment, almost the Sequoia model 7-8 years ago. What's your take? You think, in your belief, services investments can still give non-linear growth for a venture investor over a short to long term?
We definitely believe there is value in services businesses. Prior to Happiest Minds, we've been invested in iYogi, United Legs, and we've seen rapid scale up there. So we continue to diversify within the technology space that we invest in. And to your point earlier on the exit possibilities, I think it's also a way of diversifying the exit risk.
So I want to move to exits. Suvir, Nexus has seen 2 exits this year, right? And both of those have sort of been companies which have been built for the US markets or built for the global markets, right? Is that in some way a hypothesis that, hey, the exit market there is advanced, it's easier to build a technology in India, so why don't we build in India and take it there?
Yeah, I think like I mentioned earlier, we've taken a focus a few years ago that we believe that there will be companies that will be built out of India for global markets. The question, if you studied the US markets a decade ago, you'll see 1/3 of the technology starts in the US started by Indians.
Sure.
In the US, even more, probably even more.
So might as well get them here and start it here.
So we've seen some of that Indians who would have stayed in the valley or stayed in the US are now back in India.
Okay.
So the same talent exists here. It happened only over the last 2 years.
Right.
And so we believe the same talent is capable of creating global companies out of Bangalore or Pune or Bombay or Delhi. So the hypothesis is that, and then the markets are for global markets. So most of your acquirers will end up being companies that are global.
One of our earlier points, which is on large investments coming into the country, we also noticed that, hey, there seems to be a lot of money at the top for $10 million, $15 million sort of deals, but very little small money, very little funds which are focused on 1 crore to 5 crore sort of deals, right? Alok, your sense, is venture investing in this country top heavy?
I don't think so. You will always see large ticket size being announced, and there are various reasons, why that happens. I think in the e-commerce space, if you take it, most of these companies started with $1 million or $2 million. So, for everyone around the table on this panel, for example, I think the $1, $2, $3 million deals remain the bread and butter. And sure enough, once in a while, you're going to see a $10 million check there. In fact, going forward, I think there is so much activity we are seeing around angel funds, incubators, and mentors and advisors that, next year we might very well see the reversal of the pyramid, where you actually start getting a lot many more seed investments, which can then feed into the venture pipe.
Takes us to the end of the second segment of this show. Coming up over the next segment, what are the big bets for 2012? Stay tuned.